Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark believes Shanghai's stock market has peaked. Gold 2020 Forecast.com's Bull Polny says it's time for silver to sparkle. Addressing turmoil in the junior markets, Investment Industry Regulatory Organization of Canada Vice President Warren Funt explains how the rules work. We'll talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Nice to be with you, Jim.
You said the equity markets are posing for a summer rally, but there's going to be a price to pay for that.
Well, that's the classic situation here. We've gone through just so much of a quiet stretch this year. Different sectors definitely have had moves, but overall, if you take a look at the Dow or the S&P, and there's just, we're plus or minus 2% on the year right now in terms of price action. Seen some attempted rallies, had a little bit of a catalyst this week on Wednesday when the Fed decision or indecision once again to change rates put a little spark into the market for a day and a half. But by the end of it, we closed down here on Friday. The typical action, this was what we call the triple witching. This is the third Friday of June, option expiration period, and typically the week following the June expiration has a history of being down. Actually, 22 out of the last 25 years, the market has been lower by an average of just over 1%. And when we take a look at the action that you would expect in the spring and summer, you're past that best 6 months period ending the first week of May. You get into this stretch where there's just not a lot of usual leadership in the marketplace, so you tend to get choppy action. And ideally, what you end up with is a market correction in the 5 to 7% bracket in the U.S. market that is then followed by a test of the highs. And so the optimum, as I say, was to get this correction. And if we look back, you find that the latter part of June, first 10 days of July, is the window that you want to be looking at as an opportunity to be a buyer. Now, only three of the last 20 years where we did see a break into that period, did it continue down right through the summer without going back to test the highs. So the odds are very much in favor of getting a decent bounce once we've had the correction. Now, the Canadian market's already down about 6.5-7% off its highs, and it has characteristics similar to the U.S., but unlike the U.S., which typically is down 5 to 7, the Canadian market tends to be down 8 to 9%. So there's maybe another 2 or 3% here on the Canadian market to put it into that attractive-looking mode.
The Shanghai market has been the most explosive this year, but now it appears to be imploding. Can you tell us about that?
Farmers, we talked about this before, they were spending as much time sitting in front of their computers, day trading or watching the markets as they were out in the fields. By the time you get to that mode, you're clearly into that euphoric state. And we've done the comparisons, we talked about this last week, of this market, how it correlated to the gold market of the 2006 when it was going back to test its all-time high. And this was the week that Shanghai rolled over, down 6% today. That makes it 13% on the week coming off the high. The type of euphoria that we had, you do expect these kind of corrections, and it would be typical for this market to correct deeper than we've seen already. The norm on the work that we've done would show that a good 50% correction from the lows that we had in February would be a first starting point. But I would expect that in terms of the market appearance and the way it trades, will probably be a lot like what we've just seen in the U.S. dollar this last year, where you go from that vertical mode of being up month after month to then into the consolidation phase. And I would think that the Chinese market will probably turn more into a trader's market, broad range for the next few months, rather than the trending phase that it has had for the first part of this year.
Is the downturn in Shanghai a signal of what could happen here on this side of the Pacific?
Well, no, you've got a different style here. We haven't had much in the way of strong directional movement. You take a look, really, the U.S. financials have had a strong bias to them, but not euphoric. You have the biotechs, which were really strong into February, March. They've just gone through a consolidation and are coming back to life. And if anything, that's a sector which typically from the last week of June through the second week of September, you'd expect to see some strength. So I think we've got different markets out there. China's been clearly the leader. The Europeans were probably the first ones to roll over. You've got a lot of complacency out there. We don't have strong convictions from either the bulls or the bears. We did have to manage to create one of these anomalous conditions a week ago where you had, on the same day, you had more than 2% of the stocks making new 52-week highs and 52-week lows. So that anomalous condition usually precedes market corrections, but they don't have to be deep. As I say, the bulk of them tend to be into the single-digit variety.
My guest has been Ross Clark. His email, ross.clark@cibc.ca. Coming up, Bo Polny, founder of Gold2020Forecast.com on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Bo Polny, founder of Gold2020Forecast.com. Welcome back to This Week in Money.
Jim, thanks for calling and nice to be back again.
Your latest call for gold to turn up showed up within a window of time. Tell us about the turn, the window, and where you see gold going from here.
Last we spoke, I believe it was about 3 weeks ago, and it's right about the second or third week of May 2015, and we were looking for a top right around the 18th, and it came on the 18th. Gold and silver have since reversed. I think gold got up to as high as 1230 at the time, and silver got up to about high 17s. Since then, they've both reversed and dropped. We were looking for a final leg or a wave down. The leg for gold specifically ended on June 5th. June 5th specifically would have been, and it was 7 months exactly to the cycle low that we called on the 5th of November 2014. So it's pretty beautiful, but it landed exactly on the date. Since then, gold has been in a upward cycle off that date, and currently gold today is I think right on 1201, trading at 12 or closed at 1200 range, and silver just above $16. So the direction continues upwards into summer. And so from the wave formations and the wave counts, the June low is expected to have been a final capitulation wave that basically, in essence, structured in its function is to exhaust any and all remaining bulls. And from that wave, the price is expected to immediately reverse and then get extremely aggressive. So we're looking for nice price movement before this month of June is over, and so we're looking for much higher prices into summer.
Do you believe the precious metals markets are manipulated to both the up and downside, and why?
Well, I did an interview just the other day, and it's posted on my website right now. Kind of touched on that topic, but specifically manipulation that everybody describes. It's a part of a cycle, just like a war is a part of a cycle, just like natural disasters are part of a cycle. Manipulation is just one aspect of a cycle, but manipulation is a part of the cycle. And so the manipulation that has been described, or the price suppression, whatever the word one wants to use, all of that was a cycle that was to the downside, and that was the completion of the bear. Even though we truly have been in a new bull market, gold specifically has been in a new bull market as of the 5th of November 2015. You can kind of call it a stealth market if you like, because basically it's been going sideways with nothing but higher lows. But $1,130 on gold has never been touched. I think every single analyst, technical analyst out there, I hear from like all my subscribers, all these different analysts, everybody's calling for, $1,000 gold, and since November of last year, never came. And the reason was because that cycle completed on that time point. And since then, we've been in a sideways stealth market. And again, the miners have been holding quite well. And again, even gold and silver have not made any new lows. Silver bottomed a month later in the on the Swiss referendum. So that was the 1st of December. But both metals have made their bottoms, and now we're expecting price movement to the upside. So the manipulation that has been holding silver and gold down will be the same manipulation, if you want to use it, or the same entities, or the same energy that's been used to keep it down will be reversed to the upside, and then the manipulation or the price movement, and that's going to cause aggressive price movement vertical. And it's for the same reason it's been pushed down when it was in the bear cycle. When the bull cycle starts, it's the same forces that'll be taking it upwards and the price direction. Since we've had 3-4 years of aggressive price direction to the downside, I expect extremely aggressive movement to the upside.
You talk about the 252-year stock market cycle. Where does the 252-year cycle originate from?
Well, where it originates from is me trying to doing mathematical calculations based off the number 7. I go back, and I was able to go back using Google and the Internet. I can take it back. I was able to go back to the first stock crash that I could basically find was in 1785. Now it's called the monetary panic in Holland. And so that was in 1785. And then what I started doing is running multiples of 7, and I continually found that 21 was just coming up consistently. It was basically unbreakable. And so following 1785, you had 1806 and then 1827. So you had a recession-depression cycle. And so all I did was I went backwards 21 years from 1785, and what I ended up with was finding that that's where it looks like it began, was the Currency Act of 1764. So that's really how it originated, and then taking it forward, I continued to do the math, the math counts, the year counts on it, and so what it is pointing to very crystal clear is the year 2016 for a cycle low, and that comes in at 252 years. Now the problem with that cycle, it's supposed to be it's going to be a very bad low from what I'm potentially seeing here, just based on time, because 7 years works out to exactly 1,520 days. Drop the 0 and you got a 252. So it's just basically it's a completion of an entire cycle. So the 252 mark is a very critical year junction, or it's the 2016 becomes very interesting and very dangerous for people who are could be in the markets, because the low could be quite dangerous and quite low, because it is the completion of an entire 252 year cycle, which mathematically is calculated and can break down into a 7. So that's really how it originated, and we're forecasting a low in the year 2016, and I hope that answers your question.
What is a short squeeze, and what would cause a short squeeze in the gold and silver markets?
A short squeeze is when there's entities who are basically short in the market, and like right now, if you look at the open interest is at all-time highs right now for silver, and so that open interest basically means that no one's backing down, and so if the longs, the people who are on the side who are looking for it to go up, are not backing down, and the people and the other entities trying to hold its price down by putting shorts on are not backing down, it becomes extremely wild because someone's going to have to win and someone's going to have to lose. And if the cycles indicate that it's going to go up, which means that the shorts who are holding the price down are going to have to exit their position, or they're going to get squeezed, meaning the price is just going to get away from them, and they're, it just becomes very painful to financially if you don't get out of your position. So that's called a short squeeze.
What would a short squeeze look like?
Well, what it would look like would be you could use the word parabolic rise or vertical price rise. That it could actually cause an extremely large price move because it basically could reset the price. Where would the brakes go on? Where would it stop, or could it stop? So it would look like a very aggressive price move, and it could be we've been watching gold move $5, $10, $20 up and down for years now, and in a parabolic move it could be 100 or multiples of that in a very short period of time. So that's what it could look like.
What do you think would trigger a short squeeze?
Honestly, that is something that for me would be hard to answer. There are many people who understand markets and things that are going on within the world. I from a cycle perspective, look at directions of which direction the cycle is supposed to be going, but the cycle is missing the events that would trigger the movement to the upside or to the downside. So from a cycle perspective, it's retrospective. So after a move would happen, then you go back and you look, okay, what was the event? So honestly, to answer your question, I really can't answer that question. What could cause a short squeeze, or what would the event be? All I can say is, when July comes, when August comes, we can look back and see what happened here in the month of June and in the month of July.
Do you think a summer rally is in the cards for the junior markets? A rally is in the cards for the junior miners?
Absolutely. As I stated earlier, I expect gold and silver to rally into summer. There will be a top this summer that will then cause a violent or pretty aggressive drop. But yes, if gold and silver rally to the upside, which cycles indicate they will, the junior miners will absolutely move right along with gold and with silver.
Now, when you're going into gold, should you invest in an ETF? Do you look for the metal itself? Do you look for the mining companies, their stocks?
Well, that's a personal choice. There's a lot of clients that we have, that are heavily invested in paper, and they've got a lot of mining stocks, and many of them obviously they're trading the mining stocks. That's a personal choice. From a cycle perspective, my job is to really give direction, not investment advice. But personally, it's just when you talk to people who are very much in the know, you anything in your hand is always the way to go. So I think physical, personally is the only way to go with precious metals. The mining sector is obviously an interest in terms of trading, but you may not want to be in that sector too long. So again, physical, if it's in your hand, it's always a preferred choice.
I hear you're calling for a triple-digit silver in 2016. What would cause that? Well,
I did an interview just this past week, and silver's on its lows. We've got silver at $16. It's been trading here for a long time already in this range, give or take $1 or $2. And once silver leaves the $16 range, we're not going to look back. And if people are trying to catch a $12 move in gold, a $12 price on silver, which would be $3-4 lower, versus losing the possibility of silver having a massive move to the upside and getting to a price of who knows, doubling its price or more. So it's they're trying to catch the exact low versus the potential for silver is 3 digits easy, and I'm forecasting that to come in in the year 2016. So I think it's extremely important if you believe in precious metals. I think you should be holding them personally and trying to see if it might go a few pennies lower or a dollar or two lower versus having triple digits on silver. I think is just what's that saying? A penny wise,
a pound foolish. Do you think the investment demand for silver will be balanced up against its demand as an industrial material? I mean, as silver is needed for an expanding solar industry, is that a factor in your positivity about silver?
I do see silver. Again, we talked about triple digits on silver. When silver does make triple digits, we're still expecting a stock crash, and once the crash starts really grabbing hold here, silver unfortunately could get caught up, and probably is going to get caught up in some of that crash later on, and so. When the markets are collapsing, it's not like everybody's putting on solar panels on their house, to do that. But I do, so honestly, I think the monetary value of silver is going to what's going to take it to triple digits and beyond that is not the industrial demand. It's literally, I think it's just people getting their hands on the precious metal.
Bo, anything else you wanted to throw in today?
Back to, again, in terms of timing these events, that's what we do. Cycles specifically are give timing forecasts. So if we're looking for a stock market move and a crash, which we have a stock market index which will help give direction and timing of those events. For the move into 2016, for gold and for silver, we have a gold index which would help give the timing for those points. And aside from that, I would just recommend anybody just to get the big picture on precious metals. Go to our webpage and the stock market cycle, the 252-year cycle. It's there. Just spend some time studying it, have a look at it, and get to understand, how life seems to continually replay itself. And just do your homework and find out specifically about protecting your investments and how to position yourself for what's about to come.
Bo, thank you so much for being on the show.
My pleasure. Thanks, Jim, and thanks for calling.
My guest has been Bo Polny, founder of Gold2020Forecast.com, his website, Gold2020Forecast.com. Coming up next on This Week in Money, Warren Funt, Vice President of the Investment Industry Regulatory Organization.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Warren Funt, Vice President of the Investment Industry Regulatory Organization of Canada, the Western Canadian branch. He's speaking to us from Vancouver. Welcome to This Week in Money.
Thank you. Pleasure to be on the show.
And for people wondering what their website is, it's IIROC.ca, and your organization is usually referred to as IROC, right?
That's right.
The junior capital markets in Canada admittedly are in trouble, and our goal is to help find solutions to some of their many problems. We have a number of questions to ask, and we're grateful you've taken the time out to do this interview. What is exactly IIROC's mandate?
Well, our mandate's pretty broad, actually, but to summarize it as briefly as I can, we set proficiency standards and conduct business, financial, and trading reviews of our dealers and their registrants, or at least registered employees. And also, we have responsibility over the trading in the markets, so we enforce the market integrity rules and trading activities on all of the Canadian marketplaces.
Do you think it's important for IIROC employees to have member firm experience?
Many do. So I suppose by action we think it's important. There is what we do think, and hiring is part of it. But what we do think is that our employees are well trained, informed of the issues facing the industry, of our rules, and of the expectations of clients. And we think we do a pretty good job of that, but it's always a challenge, of course.
Through membership fees, brokerage firms fund IIROC. Junior venture markets thrive with full-service junior brokers. Since 2007, though, a number of junior brokerage firms that are members of IIROC have either closed or merged. Has IIROC been forced to downsize due to the closings and mergers?
No is the short answer, but there's more to it than that. It's really, first of all, you have to start, we're a not-for-profit organization, so we look at the costs to regulate and work from there in terms of what our fees look like. But more importantly, and I think really where many of the questions you may ask me come from is the industry as a whole has significant areas that are doing very, very well. I know we're asking these questions from Vancouver, and I think there's a certain kind of Vancouver mentality to that, and that's fine. But I think we need to be very aware that there are large portions of the industry in Vancouver and around the country that are doing extremely well.
What are those sectors?
Those would be more in the portfolio management kind of side, the manage money, not the typical transaction-based, I'm thinking sort of historical here, transaction-based, corporate finance-dependent type of firm that we used to see more commonly, a business model that was more commonly seen in the 80s.
And would that be more venture exchange, mining industry stocks, that kind of things?
Yes, certainly those companies that did and even still do to some extent concentrate on the junior part of the market are of course more resource based. That's the nature of the junior market. It's made good steps, and that's really not for IIROC to do, but the markets have made good steps at broadening their listings base and the types of businesses they're in over the decades, but it still is predominantly a resource-based market of one sort or another.
Brokers have told us that up to 60% of their revenues are tied up in compliance costs. Can IIROC reduce the cost of compliance so independent brokers can survive in a very tough market?
Well, I really don't know where that 60% number comes from and whether it sounds a little strange to me, but I'm not going to quibble over that because I certainly can agree that compliance costs are a significant cost of doing business. So whether it's 60% or some other number perhaps is really not relevant. Let's just deal with whether compliance is kind of in the way. I think we have to sort of set the stage here a little bit because I think everybody agrees that compliance is needed. Regulation is needed. We can't have a completely unregulated market. So it's really not compliance costs. It's getting the balance right, so that investors are protected, so the market has its integrity, so there's confidence in the markets, and so there's activity in the markets. That's what really, as you started with, our mandate is part of, but certainly not only IIROCs, other regulators too. So that's, I think you have to start in that position, and then there is the question of do we have that balance right? And again, I think we also need to look at these are all firms that we're talking about. Our compliance really doesn't differ from small firm to large firm in terms of the rules, how we apply those rules and the reviews that they see. That does differ. That is risk-based. That is meant to be more proportionate, and we try and get there. So at the end of this, when you really say are compliance costs excessive in some way or are they higher than they need to be, we don't think so in terms of the compliance areas that we're involved in, but we are always open to ways to be more efficient and effective at providing that necessary regulation.
I think one of the questions, one of the brokerage firms posed to me was, why do we have to print so much paper to give to prospective investors when everybody's online these days? Couldn't they switch to a computerized model rather than using paper?
We agree, really. Paper is a challenge within this industry. There's limitations as to what we can do about it as IIROC. A number of regulators and laws are involved. They're not easily changed. But I think we'd have to agree in that regard that more can be done to take away the paper-based nature of it. Having said that, although the thickness of the paper may be relevant, much of the content, or the thickness of the paper may be a challenge. The content, most of it is there for good reason and has been reviewed over time. In fact, I would encourage clients to read it, and I would encourage brokers to be as clear and concise at explaining it to their clients. That is part of their obligation.
Some might have the perception, right or wrong, that the independent brokers are being squeezed out of the industry through costs of overregulation to the benefit of the big banks. Is there an opportunity to provide incentives for the creation of new independent full-service brokerage firms?
First of all, independent firms are being created, and probably bank-owned firms are not. But they are being created. But again, I'm not trying to quibble with your question, but I think what you really mean as much as anything is whether we're going to see more of that traditional business that I described as an answer to a previous question, which is, that more traditional corporate finance-based, transaction-based type of firm, and it's IROCs, and in fact, the requirements don't at all separate out by type of firm. That's not the way it's looked at. There are requirements that must be met, and if they're met, then the firm will become a member. I think it's also worthwhile to point out, though, that over the years, there's been, as much as technology has produced challenges for some of the firms, it's also made it a lot easier over the years. And what I mean precisely by that now, as opposed to some time ago, it's easy to outsource the back office activities. Most firms do actually outsource their back office activities. You can outsource most of your trading, so that in terms of setting up a firm, it is pretty easy to concentrate on the business aspect and outsource many of the other activities. Of course, you can't outsource the responsibility for it or accountability for it, but financially they are in more pieces than perhaps they used to be. I'm not saying it's easy or cheap to set up a new dealer, but it's certainly possible. We certainly see that activity for certain types of business models.
Is overregulation choking off retail investing in junior issuers?
Well, again, I think I'm quibbling with your questions again, but it's not overregulation, because obviously we don't think there is overregulation. It's whether regulation is in some way choking off investment. There's two sides to look at that. Part of what we do is we do protect investors, and particularly vulnerable investors. That's part of what securities regulation as a whole does. And in fact, the opposite is also true. Securities regulation has a much lighter touch on those people who are sophisticated and might be able to withstand losses and make more independent advice. That's part of how regulation is structured. So there's no part of the regulation that says, of regulations that say, oh, this type of business is inappropriate and this type of business is appropriate. The focus is, how do you protect the investors properly to the right level, to their right need? And we don't think that the retail investor as a whole is being choked from that, to use your word. We think the balance is about right. But regulation is always being reviewed, reevaluated, and if something comes up that can be done better, then we'll do our best to make it happen.
Does IIROC have the power to start deregulating for the juniors, and what can IIROC change to stimulate retail investing?
We don't, in our mandate, we don't regulate the issuers. We regulate the trading of the issuers, which is slightly different. So really, we don't have that specifically under our mandate. We do work closely with the other regulators, primarily the commissions, who do have more of those powers, and I think the Western commissions, actually I think most of the commissions, but have shown a real desire to move in that direction. We've seen prospectus exemptions that have come into play that we hadn't seen before, and I think that shows that the regulators are responding. But precisely, it's not in IIROC's mandate to change regulation on the issuers in any way.
What have IIROC studies into high-frequency trading revealed?
Well, in the context of this conversation, looking primarily at the juniors, there isn't a lot of activity by HFT in the juniors. And I would also say that the studies themselves were not finished those. There is at least one more to be made public. All the others have been made public so far and are available on our website. They are in some ways quite technical, but they certainly don't indicate an immediate need for regulatory change, but these things are still being considered and analyzed, and we'd certainly like to see the last one before any action is considered.
I know that in New York, for example, one concern that was brought up is with the high speed of trading, just being physically closer to where the trades are made, those nanoseconds could make a difference in the trade. Is that a concern that's been raised?
In the junior markets, you need to be careful as to how we generalize, and I know you didn't use the word HFT or the initials the initials for high frequency trading in your question, but computerization is active in all trading venues. HFT is a trading behavior. It's not a firm. It's not an entity. It maybe have certain characteristics as a behavior. One of those behaviors is that we see amongst many players, however we define them, is what we call low latency trading, which is it possible to be faster than the next guy, and is there some advantage to being that way? I'm not sure that's a large factor in the venture market. It has some impact, but not a large factor, because it's certainly not. The liquidity is just not there for many of the types of transactions you see. But it is a concern to many, and whether it's a good thing or a bad thing is a topic of debate internationally.
The junior venture markets can be an engine for the Canadian economy as soon as shorting is banned on the junior exchanges. Do you agree or disagree with that, and why?
Well, again, shorting is has many different aspects to it, and one of those aspects, and that people argue, and at least the way regulation sits at the moment, it is seen as creating the most efficient and effective market by really not having significant or artificial restrictions on short selling. There are restrictions on short selling in terms of their settlement requirements, and those are very much in place and enforced so that they cannot be abused. IIROC's focus on the upside of the market or the downside of the market, meaning if there was illegal shorting, or is we look for manipulative and deceptive trading, and whether that's from short selling or manipulation on the upside, that's what we're looking for, and I don't think short selling has a specific link that causes us huge concern.
The Uptick Rule in the U.S. was repealed in 2007 after being put into effect during the Depression of the 30s. Without the Uptick Rule, U.S. markets collapsed in 2008. The removal of the Uptick Rule in the U.S. shows the devastating results when predators can destroy companies and when they have unlimited shorting. The Uptick Rule in Canada was repealed in 2012, and since then, there's been little growth in the TSC and the devastation of the venture exchange. A partial reinstatement of the Uptick Rule was made in the U.S. in 2010. Since then, the Dow has almost doubled. With this evidence, will IIROC reinstate the Uptick Rule in Canada to regain the confidence of the investment community?
I have real problems with the linking of the Uptick Rule to the results of the financial crisis. I think that's frankly a stretch. But nonetheless, I again will take the question in more in the spirit I think that it's meant. Is the Uptick Rule a good thing or a bad thing? The Uptick Rule hasn't been shown in its presence or in its absence from any of the work we did, which was much of it back in 2007, but has been looked at since, and don't really see a data-based argument for the Uptick Rule to be reinstated. I would make a couple of points with that, though. Really, an Uptick Rule is trying to discourage a bear raid, as it's called. This would be an ongoing and sustained selling of the stock that you don't own. Many things have changed over time. One of them is our knowledge of what goes on in the clearing and settlement system and how that's visible to us. Because if you sell a stock, you still have to at some point deliver it, which means you're borrowing it from somewhere or you're failing on your delivery at T+3. We can watch that type of thing. We know we can see what's going on, and if there is an extended bear raid, that clearly falls into manipulative and deceptive trading, and it is something we could enforce. But it's not something we commonly see, and in fact, if there was a sustained basis that short selling that some of your listeners see, we would be very interested in hearing about it, because at the time that it occurs or soon thereafter, because we can certainly go and look at with the information that we have and determine whether there's something that is truly amiss in that. Often there isn't. I would also point out that the rules in the United States, by the way, do not have an uptick rule. The only reference to an uptick rule now is it's combined with a circuit breaker. So if the price of the stock falls with 10% in one day, there is essentially an uptick rule that gets imposed. We don't have such a rule. I'm unclear or unsure whether it was ever actually been lived by or adhered to in the United States, meaning it's been triggered, not that it hasn't been enforced, meaning whether it's been triggered. Don't know. Suspect not, but maybe. And the other point I'd make is that to just reinstate the uptick rule sounds so simple, but it's not. And the uptick rule was developed, as you said, in the 30s, and it went by the wayside for good reason. As market structures changed, whether it was a good rule or a bad rule, it was an unenforceable rule, which makes it a bad rule in some ways. But what I mean by that is you have to be able to determine what the uptick is. And and when there's multiple marketplaces trading very, very quickly, or can be trading very, very quickly, it is difficult for everyone to know what the last tick is and know whether you're selling on an uptick or not. It's also a Canadian restricted rule, so it assumes you have borders that you can enforce, which you can't. Many venture stocks, and certainly TSX stocks, trade in the United States and other countries too. So it is impossible to trade. It's possible to just totally ignore the uptick rule, even if it exists, by forcing trading south of the border. And why would we want to do that? The final point I'd make is if you didn't accept any of that, it would be just plain expensive to coordinate the markets and make that happen. And to say and clients end up paying that expense at the end of the day, one way or another. And so to make that kind of rule change without evidence that it's necessary or would have the desired effect, a rule that is difficult to enforce and possibly easily avoided, possibly even creating in consequences of forcing trading out of Canada is not something that we're likely to do. We will now. There may be other arguments come up for the Uptick Rule, and as usual, we would certainly look at those. But as it stands today, we really don't see the justification for reinstating the Uptick Rule.
The SEC banned the shorting of banks and certain financial institutions in October 2008 to save those institutions. Does Canada have a similar ban?
No, we don't.
Is it because our banks are just simply in better shape?
Well, no, I think it's no, I don't think that's necessarily the answer, and it's quite a historical question. At the time of the financial crisis, there were real concerns around the world, and there were efforts put in place to restrict shorting on certain institutions. Canada matched it because they were interlisted. Goes to my previous point. You don't live in we don't live where our borders are walls that can't be surmounted. So we matched it at the time, and then I'm a bit unclear in our history as to when they came off in the United States, but they did come off in the United States, and they came off in Canada, of course, at the same time. So there's no ban on short selling, and there may be somewhere else in the world now, but I don't think there's many. And there were a number of academic studies done after that period of time, and it did show that the effects on the markets were to actually widen trading spreads, generally speaking. These aren't active stocks, but to widen trading spreads. It wasn't seen as a helpful thing. It turned out as probably costing investors.
Many brokers are concerned that perhaps excessive regulation is strangling the junior markets, but do you feel we have just the right amount, or is that something that has to be tweaked on a constant basis?
Certainly, it's always being tweaked on a constant basis. And again, it goes back to my answer on one of the other questions, which is, the regulation is also there for vulnerable investors, all investors, and in particular vulnerable investors. But I also don't think you can directly link or only link regulation to the challenges facing the venture markets. There's many other things that are changing in the industry, in society, that I think may be affecting, it's tough to know for sure, but may be affecting the venture market too. And, just to give you a sense as to what some of those may be that affecting may be affecting the venture market is that technology, that how people access the market, demographics, older population, lower risk profile perhaps, competing risk products, going back over time, if you wanted a high risk investment, the junior markets may have been one of the few that were there, but we've seen the evolution of FX trading become retail, of ETFs of one sort or another allowing for easier speculation, derivatives as a whole, options specifically allowing for it, and others. But those just give you a sense that there are many investments competing for that risk dollar now, and and does that have an effect on the venture market? I don't know, but it certainly could, in my mind.
The Securities Commissions of BC, New Brunswick, and Saskatchewan published a proposed exemption to allow a listed issuer in Canada to do an offering to non-accredited investors as long as the offering is brokered through an IIROC dealer. Proposed is a no minimum size order, and it allows all retail investors and clients to participate on a company's offering subject to a $15,000 limit per person. Does IIROC support this proposal, and do you think this will bring investors back into the market?
First of all, I think there's two proposals in there that are mixed together. One is the existing shareholder exemption, which is a prospectus exemption, and the other is the investment dealer exemption, both as they're sort of commonly referred to. The investment dealer exemption isn't in place; it's just out for comment, but it does not have a limitation, price limit, or a dollar value limitation on it, as you described. So so they're both out there. But again, does that, to what extent do we support that? We're a regulator in this, not the driver of this. We're not representing the industry in it. We commend the commissions for coming up with hopefully better regulation and constantly trying to improve regulation, but we're not going to take a position as to whether it's going to help or hurt in this case, or whether it's even good or bad. That's what the Securities Commissions do, and that's why they put it out for comment as it is now.
It's like a policeman does not draw up the law; he just enforces it.
That's part of it, yeah. And the commissions, of course, do have oversight responsibilities for us too. So, and we deal with all of the commissions, not just the three who are who have suggested this exemption.
We're hearing concerns the CRM, the client relationship model, may appear to some to punish brokers and brokerage firms for representing TSX venture companies to investors. What's IIROC's position on that?
The client relationship model is really a modification or an extension of the current status of regulation. Suitability is the underpinning of what we look at and has been for many years. The client relationship model takes it really to another step. So in addition to us looking at a client's age, employment status, net worth, investment objectives, for example, we also then start looking at time horizon too. All of these were important changes as CRM came into being, and CRM2, which is the next part and is also coming into play, which has more to do with disclosing fees, the relationship itself, and with the performance of a portfolio. The reason this becomes relevant and why I too have heard so much about it in the context of the venture market is there seems to be an understanding or misunderstanding that in some way this prohibits investment in the junior markets, and frankly we don't understand where it comes from, because CRM brings in a portfolio approach to how the market is looked at. And by that I mean, and I'll do it by example, by that I mean rather than in the past where every recommendation a broker made to a client had to be suitable, the portfolio has to be suitable. So therefore, if in the past a broker in a $100,000 portfolio had made a $5,000 recommendation of a high-risk venture security, that recommendation would have been offside in the past. Today, in a portfolio approach, if the other $95,000 of the portfolio are invested in conservative, low-risk securities, then that recommendation probably is not offside. So it certainly allows for participation in the market, in the junior markets. Where some of that misunderstanding may have come from is firms which, for their own business, for design of their own business models, may have put in higher standards, which they are free to do, of course, to have higher standards than what the rules require. And we think some firms may have done that. They could have done it for reasons of their own business model. They could do it really for systems reasons, and systems being convenient in this case, where it's easy for them to identify what are the junior securities on venture, CSE, or any of the other markets, and then essentially flag those securities if they're recommended, not necessarily prohibiting them, but at least flagging them, and it's easily misunderstood. But to stress the point, it is not a limitation of regulation that prevents recommendations being made on securities on venture.
The proposed National Securities Regulator initiative has caused concerns it will kill the dynamic efficiency of the junior venture markets in Western Canada. What is IIROC's view on that?
Well, the Cooperative Regulator, Cooperative Capital Markets Regulator is actually what it's called, which is, of course, not in place yet and does not involve all of the provinces. It's 5 of them at this stage. IIROC's role is to deliver efficient regulation. We're already national. We work with all of the commissions. and we'll continue to work with the cooperative capital markets regulator when it comes into place. I'm not sure. I'm not sure on what basis people could automatically be assuming that it would be a problem for the way the junior markets work. But certainly from IIROC's perspective, our role is to be national and to be as efficient and effective at our regulation of the marketplaces as we can. And we do that with the help and support from the commissions.
What's the difference between independent brokerages and exempt market dealers, and why is there one set of rules for independent brokerages and another set of rules for exempt market dealers?
Well, first of all, they're not our rules. Those are Securities Act requirements, and they relate to registration. Exempt market dealers are not IIROC members. That's just the way that's a registration requirement. So those two do not overlap. Exempt market dealers are allowed to trade in exempt product which means without prospectuses to accredited investors. Or not just accredited investors, to any investor where there is a prospectus exemption. Why are there two separate sets of rules? They're really meant to be two different businesses doing different things, but they do overlap occasionally, and that can be a concern, but the EMDs or exempt market dealers are restricted in terms of what they can do too. So it's not that they compete head on. That would be in all areas. The one area where they do compete, and it's difficult to know how much activity is there, is some of the corporate finance activity that we see in the junior markets. How active that is, I've never seen any numbers to know exactly how big it is.
In Canada, there's now more competition for stock exchanges and automated trading systems. Has this created a better or worse investment environment for the retail investor, and why?
That's really a market structure question. Is the market structure right for the Canadian marketplaces as a whole, and Canadian investors as a whole? The trading patterns has certainly changed over recent years. There's no doubt about that. I think investors sometimes find it much more confusing than it used to be, but whether they are actually getting whether they're being harmed by it in some way, that's part of what IIROC and others continue to try and better understand, and our role is to provide data and analyze that data to encourage that conversation to actually get to some of those answers. I think it is extremely complicated, but it's complicated, and certainly the answers aren't obvious as to whether investors are worse off for some reason, and whether all investors are worse off for some small group, and some small group may be regulatorily proper, actually, for one group to finance another. Just depends on what it is.
Should the capital gains exemption be increased to attract investment?
That's one I just can't answer, can't comment on. It's a tax question. IIROC wouldn't take a position on that, nor would I.
Is IIROC willing to sit down and work with companies, brokers, and investors to streamline and improve the junior venture markets in the country?
Of course, and we do, and have. So we've organized more than one event to try and better understand that, to meet with people, so there is some dialogue. We're always willing to do that, and as I say, have. So the door's open for a reasonable conversation.
I think that's one of the things that makes us Canadian, isn't it? We like to discuss stuff and try to work out things that work for both sides.
Yeah, it's. I'm not sure there's sides in this. Is the only place where I'd.
Or different interests.
Different interests, perhaps, or different perspectives on it. certainly people, as they come to the table, as we've seen on this, I mean, quite naturally, the view of an issuer, the view of a dealer, the view of a regulator, all looking at the same thing, are going to look at it different ways and different perspectives. And I left out the investor in that, which was a big mistake. You know, that they all have different interests, and it's tough to balance them. But it's not a matter of compromise as such. It's a matter of trying to get it right for the general good. But inevitably, in the general good, some may do better than others.
Warren, thanks a lot for being on This Week in Money.
All right, it was a pleasure. Talk to you again soon, perhaps.
My guest has been Warren Funt, Vice President of the Investment Industry Regulatory Organization of Canada. Their website, IIROC.ca. That wraps up our show for this week. Thanks to our guests, Ross Clark, Bo Polny, and Warren Funt. And thank you for listening. Comments or questions for This Week in Money can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.